The billionaire investor Nelson Peltz recently gave a compelling interview where he shared a sobering perspective on the current stock market euphoria. According to Peltz, the post-election market boom that we've seen in the past is unlikely to persist in the long term. His words struck a chord: trees don't grow to the sky. This phrase serves as a cautionary reminder for investors. Markets may rise, but they don't do so forever without interruptions. Corrections and downturns are inevitable, and understanding how to navigate through these phases is key to successful investing. The reality check. Peltz isn't alone in sounding the alarm. Recently, Goldman Sachs released a report estimating that the S&P 500 will deliver an annualized nominal return of just 3% over the next 10 years, a far cry from the double-digit returns investors have enjoyed in recent years. While some forecasts have fluctuated post-election, the underlying message is clear: expectations must align with reality. Many investors fall into the trap of assuming markets will continue their upward trajectory indefinitely. But history teaches us that markets are cyclical. Recessions, corrections, and periods of stagnation are all natural parts of the economic landscape. Lessons from history. Did you know that over the last 100 years, the United States has experienced 16 recessions? That's more than one recession per decade. Despite these downturns, the market has historically averaged 10% annual returns over the long term. But here's the catch: averages don't tell the full story. Those 10% returns don't mean every year is a win. Some years bring significant losses, while others see substantial gains. Investors who don't understand this volatility often end up losing money. They buy high during market euphoria and sell low during downturns, driven by fear and uncertainty. The psychology of investing. Successful investing is as much about mindset as it is about strategy. Markets are unpredictable. No one knows for sure what will happen next year, let alone over the next decade. That's why it's crucial to remain grounded and avoid emotional decision-making. Long-term investors who adopt a disciplined approach investing consistently, regardless of market conditions, are the ones who tend to come out ahead. It's not about timing the market, it's about time in the market. Peltz's advice for smarter investing. So, what does this mean for you as an investor? Here are some key takeaways inspired by Peltz and other financial experts. Avoid euphoria. Don't get swept up in the excitement when markets are soaring. Remember, what goes up must come down. Stay diversified. Focus on building a diversified portfolio that can withstand market turbulence. Consider low-cost index funds or ETFs that track the S&P 500 for broad market exposure. Think long-term. Investing isn't a get-rich-quick scheme. It's a slow, steady process of wealth building over years, sometimes decades. Prepare for recessions. Recessions aren't a matter of if but when. Use these periods to find opportunities to invest in quality assets at discounted prices. Passive versus active investing. For most people, passive investing is the best strategy. Set up an automated plan to invest a fixed amount of money into the market regularly, whether that's weekly, bi-weekly, or monthly. This consistency eliminates the guesswork and helps you stay invested through both highs and lows. For those who want to be more active, understand the risks involved. Research individual companies thoroughly and be prepared to hold them long term. Active investing isn't about chasing quick profits, it's about identifying and committing to high-quality opportunities. Why strategy matters. Nelson Peltz's warning isn't meant to scare investors, it's meant to prepare them. The stock market is a powerful wealth-building tool, but it requires patience, strategy, and a clear understanding of its inherent risks. As history has shown, the best opportunities often arise during times of uncertainty. When markets are down, many panic, but savvy investors see these moments as opportunities to buy valuable assets at a discount. Nelson Peltz's insights serve as a timely reminder to remain cautious, stay informed, and prioritize long-term financial health over short-term gains. No one can predict the future, but with the right mindset and strategy, you can navigate whatever the market throws your way. So, as we move forward in these uncertain times, take a step back, zoom out, and focus on the bigger picture. True wealth isn't built overnight, it's cultivated over years with patience, resilience, and smart decision making. What do you think about Peltz's perspective? Share your thoughts in the comments below.